Welcome back to Investing Talk Podcast.
Great to be back.
Today we're taking a closer look at Sibanye Stillwater. It's a multinational mining and metals group.
That's right. And there's been quite a bit happening with them recently.
Exactly. You shared several pieces, different updates, and, well, our goal here is to unpack what's most important for you to understand right now.
We'll try to synthesize things, recent developments, market impacts, and we also have that detailed due diligence report to factor in. Should give a pretty clear picture.
Okay, so what info do we have on the table?
We've got news on their Castle wind farm coming online, some important strategic project status updates from Europe for their lithium and gallium projects.
Battery metals related. Interesting.
Definitely. Also, a change at the top, a new CEO designate, and a pretty substantial streaming agreement.
Right, that $500 million one. And then there's the market reaction.
We saw that stock price surge, analyst upgrades RBC Capital specifically, and, higher trading volumes, plus the deeper financial dive.
Okay, let's get into it. Let's start with energy. That Castle wind farm is now operational. What does that really signal about their strategy?
Well, it's a tangible step towards, renewables. It suggests they're thinking longer term than just extraction.
Sustainability goals?
Yeah.
Or maybe just cutting energy costs?
Probably both, honestly. Lowering their carbon footprint looks good, becoming increasingly important for investors, but it should also eventually impact their operating expenses positively. It fits a broader industry trend.
Okay, makes sense.
Yeah.
Now, Europe. The European Commission gave strategic project status to Calibre Lithium and Gallium. For someone potentially interested in battery metals, how significant is that?
Oh, it's quite significant.
Yeah.
That designation, it often helps cut through red tape, think faster permitting, potentially better access to EU funding mechanisms.
So it could accelerate things.
It certainly could. For their lithium and gallium ambitions, especially in the electric vehicle supply chain context, this might really help them ramp up faster than they otherwise could have. It's a positive signal for that part of the business.
Got it. Now, management changes. A new CEO designate appointed internally. We don't have the why for the retirement or the full bio of the new person from these sources, but leadership changes often mean something. What questions does that raise?
It always raises questions, doesn't it? An internal pick might suggest continuity, sticking to the current path.
But not necessarily.
Not necessarily. A new leader, even an internal one, might have different priorities, a slightly different vision. So you'd want to watch for any communications coming out about their focus areas, any subtle shifts in direction for Sibanye Stillwater.
Worth keeping an eye on. Okay, let's talk money. That $500 million streaming deal with Franco-Nevada, gold and other metals involved, selling future output for cash now. What's the upside and downside there?
The big upside is immediate cash. $500 million is significant. They can deploy that capital maybe on those battery projects we mentioned, maybe paying down debt, general corporate purposes, flexibility, basically.
And the downside?
The downside is they give up future revenue from that portion of production. If, say, gold prices soar much higher than expected, they won't capture all that upside on the stream ounces.
So they're trading potential future gains for certainty now.
That's a good way to put it. It de-risks things a bit in the short term, locks in value, but caps some future potential. It's a strategic choice about where they see metal prices going and where they need capital most urgently.
Okay. The market seemed to like some of the recent news. Stock jumped over 10%. RBC Capital upgraded them. What drove that upgrade specifically?
RBC moved them to outperform from, I believe, sector perform and raised the price target. The commentary pointed towards those strategic mining expansions they're undertaking, plus the renewable energy developments like the wind farm.
So combination of factors catching their eye.
Seems that way. And the increased trading volume suggests other market participants were reacting positively too. It signals a shift in sentiment, at least for now.
How much should someone rely on analyst calls like that, though? And interestingly, the report still mentions a speculative risk tag. Why the caution, despite the upgrade in price jump?
Analyst ratings are, one data point. Useful input, definitely. These firms do a lot of homework, but they aren't crystal balls. Your own research, your risk tolerance, That has to guide your decisions.
Right.
As for the speculative risk tag, well, it's mining. It's inherently risky. Commodity prices swing wildly.
True.
Regulatory environments can change, operational challenges pop up. So even with positive developments, those fundamental sector risks persist. The tag is likely just acknowledging that underlying volatility.
Okay, let's pivot to the financials themselves, beyond just the headlines. Revenue looks huge, around $114 billion reported, but then a net loss of $379 million in 2023. Headline earnings were positive, but way lower than revenue. How do we square that circle?
Yeah, that does jump out. High revenue, but a bottom line loss usually points to significant costs, maybe impairments, write-downs, or other one-off charges hitting the net income figure.
Things excluded from headline earnings.
Often, yes. Headline earnings try to give a sense of the core operational performance by stripping out some of those volatile or non-recurring items. The fact it was positive suggests the main mining operations were generating some profit, but other factors dragged the overall result into the red for the year. You'd need to dig into their full financial statements to see exactly what those factors were.
So operational profit, but weighed down by other things. What about the balance sheet? Debt to equity seems manageable at 2.9, lots of assets. But the due diligence report also flagged declining earnings per share and concerns about return on capital. Kind of conflicting signals.
It is a bit conflicting and highlights why you need to look at multiple metrics. A manageable debt ratio and a strong asset base are generally good signs of stability.
Provides a buffer.
It does, but declining EPS means profitability per share is shrinking. And concerns about return on capital suggest they might not be generating profits as efficiently as they could be from the money invested in the business. So you have balance sheet strength potentially offset by weaker profitability trends. It's not uncommon, but it's definitely something to watch closely.
Let's talk strengths and weaknesses overall. Diversification into battery metals, sustainability focus. Those seem like pluses. The loss we just discussed, no dividend, potential minuses. How should someone weigh those?
It really depends on the individual investor's priorities. The battery metals diversification is strategically sound, tapping into future demand. Sustainability is increasingly non-negotiable for many funds and investors.
ESG factors.
Absolutely. But that loss needs context. Was it a one-off, or is it a trend? And no dividend. Well, if you need income, that's a clear negative. If you're focused purely on long-term capital growth, you might accept reinvestment over payouts, assuming the reinvestment generates good returns.
And what about their recycling operations? The report mentioned that differentiates them from, say, Anglo-American Platinum or Impala Platinum. Why is recycling an advantage?
Recycling can be a very attractive part of the business. It often provides a more stable, less geopolitically sensitive source of metals compared to primary mining.
Less digging required.
Less digging and potentially lower processing costs depending on the feedstock. Plus, it strongly reinforces that sustainability angle, the circular economy concept. It can offer better margins sometimes and reduces reliance on discovering and developing new ore bodies. It's a smart hedge.
Valuation time. Price to book around 1.01, so trading near book value, no dividend, as focuses on reinvestment. Major risks cited. Commodity prices, regulations. Given the recent stock run-up, how do these factors frame the current investment case?
A PB near 1 often suggests the market isn't placing a high premium on the company's assets relative to their accounting value. Could mean it's fairly valued, could mean it's undervalued if you believe future earnings will improve significantly, or it could reflect those concerns about profitability we mentioned.
So not a clear buy or sell signal on its own.
Rarely is. Coupled with no dividend, it reinforces the reinvestment for growth story. But you have to weigh that against the risks. Commodity prices are the big one out of their control. Regulatory hurdles can pop up anytime in mining. So the recent surge is positive, but it doesn't negate those fundamental risks. The current price reflects a mix of optimism about strategy and caution about the sector.
Looking forward then, strategic expansions, battery metals growth are the potential catalysts, but the commodity price dependence and regulatory navigation remain. What specific developments should someone really keep tabs on?
Definitely track the progress of Calibre and Gallicam in Europe, milestones, funding news, timelines, especially with that strategic project status.
See if that status translates to speed.
Exactly. Also, any news on their renewable energy targets and cost savings achieved there. And of course, the prices of platinum group metals, gold, lithium, gallium, those will heavily influence revenues. And keep an ear out for any significant regulatory shifts in South Africa, the US, or Europe where they operate.
So wrapping this up, Sibanye Stillwater presents a picture of, well, a company actively transforming. There's positive market momentum, but also these underlying financial questions and complexities.
That sums it up well. The push into renewables and battery metals is forward-looking, potentially positioning them well for energy transition trends. But the recent loss, the lack of dividend, the inherent mining risks, those need careful consideration.
The analyst upgrade and stock move show current optimism, but the deeper dive reveals a more nuanced story, right? Lots of moving parts for someone to evaluate.
Definitely. It's not a simple picture. You have strategic positives potentially offset by financial headwinds or sector risks.
So maybe the key takeaway is the tension between that strategic repositioning and the current financial performance metrics. What should someone be thinking about next if they're following this company?
Perhaps considering how much weight to give that future potential in battery metals versus the current challenges in traditional PGM markets, and how patient they're willing to be for that strategy to fully play out, especially given the reinvestment focus instead of dividends.
A lot to mull over. We hope this discussion has helped clarify the key developments around Sibanye Stillwater from the information provided.
Hope it was useful.
If you found this valuable, please do subscribe, like the video, and maybe drop a comment letting us know what other companies or topics you'd like us to explore.
We appreciate the feedback.
Thanks for tuning in to Investing Talk Podcast.